Look, I need to talk to you about this new Fed chair appointment for 2026 because what you're hearing from the mainstream media, from Wall Street analysts, from all the talking heads on CNBC is absolute fantasy. And the longer people believe this narrative, the worse the inevitable crash is going to be. Everyone is acting like a change in leadership at the Federal Reserve is going to somehow fix the fundamental structural problems in our economy, like getting a new captain on the Titanic after it's already hit the iceberg is going to prevent it from sinking. The markets are gyrating. Bitcoin is moving wildly. Gold is responding, and everybody is trying to figure out what this means for their portfolio in 2026. And I'm sitting here watching this circus thinking, how is it possible that people still don't understand that it doesn't matter who sits in that chair? It doesn't matter what their academic credentials are or official national debt. And that's not counting the unfunded liabilities for Social Security and Medicare, which add another 100 trillion or more to the real debt picture. Interest payments on the national debt are now exceeding defense spending, exceeding what we spend on most major government programs. We're borrowing money just to pay the interest on the money we already borrowed. This is a debt spiral, and there are only two ways out of what their stated philosophy is, because the Fed is trapped, and whoever takes over is going to be forced to do exactly what Jerome Powell did, exactly what Janet Yellen did, exactly what Ben Bernanke did, which is print money and destroy the currency, because that's the only option they have left. Here's what's really going on, and nobody wants to talk about this. The United States government is running deficits of $2 trillion a year. We have $35 trillion in debt spiral. You either default, which would mean the government stops paying Social Security, stops paying Medicare, stops paying government workers, stops paying the military, and that's political suicide. So no politician is ever going to choose that option. Or you inflate, you print money, you devalue the currency, you pay back your debts in dollars that are worth a fraction of what they were worth when you borrowed them. The new Fed chair, whoever it is, comes into office, and what are they going to do? The market is already pricing in rate cuts. Wall Street is salivating over the possibility of easier money. Stock investors think a new Fed chair means lower rates, and that's going to send stocks to the moon. Bitcoin enthusiasts think looser monetary policy is going to drive people into crypto as a hedge against inflation. And the gold market, which actually understands what's happening, is already starting to move because gold knows that no matter who runs the Fed, the end game is the same. More money printing, more currency debasement, more inflation. Let me tell you something about the stock market right now. We're at valuations that are absolutely insane by any historical measure. Price to earnings ratios are in the stratosphere. You've got companies that don't make any money trading at billion-dollar valuations because there's so much liquidity sloshing around in the system looking for a return. And where did that liquidity come from? It came from the Federal Reserve's balance sheet expansion. It came from years of quantitative easing. It came from interest rates that were held at zero for over a decade and are still nowhere near where they would be in a free market. The stock market isn't reflecting real economic growth or real productivity gains or real wealth creation. It's reflecting monetary inflation. It's reflecting the fact that when you create trillions of dollars out of thin air, that money has to go somewhere. And a lot of it goes into financial assets. So when people ask me what the new Fed chair means for stocks, here's my answer. In nominal terms, in dollar terms, stocks might go higher. They might go a lot higher if the Fed goes back to aggressive easing and money printing. But in real terms, adjusted for inflation, adjusted for the loss of purchasing power of the dollar, stocks are going to be a terrible investment. You might see your portfolio balance go from 500,000 to $1 million, but if the cost of everything has doubled or tripled, have you actually gotten wealthier? This is the con that the Federal Reserve has been running for decades. They create inflation. Asset prices go up. In nominal terms, people look at their brokerage statements and feel rich, and they don't realize that their purchasing power hasn't increased at all or has actually declined. And Bitcoin. Don't even get me started on Bitcoin. The crypto enthusiasts think that a new Fed chair who's dovish on monetary policy is going to be great for Bitcoin because people will flee the dollar and go into crypto. But Bitcoin is not money. It's a speculative asset that trades on hope and momentum and the greater fool theory. When the real crisis hits, when people need actual money to buy food and pay bills and survive economic chaos, they're not going to want Bitcoin. They're going to want something with 5,000 years of history as money, something that central banks hold in their reserves, something that doesn't require electricity and internet to function. They're going to want gold. Gold is the only asset class that actually makes sense in this environment. Gold is not somebody else's liability. It can't be printed by central banks. It can't be debased by government decree. It's held its value over centuries and millennia, while every single fiat currency in history has eventually gone to zero. The new Fed chair doesn't change any of that. In fact, the new Fed chair, regardless of what they say in their confirmation hearings about fighting inflation and maintaining price stability and all the usual nonsense, is going to end up printing more money because they have no choice. The system requires it. The debt requires it. The political pressure requires it. Think about the position the new Fed chair is going to be in. They're going to have the White House pressuring them to keep rates low, to support economic growth and keep the stock market up because presidents get reelected when markets are high and unemployment is low. They're going to have Congress pressuring them to monetize the debt because Congress wants to spend money on programs to buy votes and they don't want to raise taxes to pay for it. They're going to have Wall Street pressuring them because the entire financial system is addicted to cheap money and leverage. And if rates go up significantly, the whole thing implodes. And they're going to have foreign creditors who are already nervous about holding trillions in U.S. Treasury debt. And if rates spike and bond prices crash, those foreign central banks are going to dump treasuries and create a crisis. So the new Fed chair is going to do what every Fed chair does. They're going to talk tough about inflation. They're going to say they're data dependent. They're going to pretend they have everything under control. And then they're going to cut rates, and they're going to restart quantitative easing, and they're going to print trillions more dollars because that's the path of least resistance. That's the path that avoids an immediate catastrophic default. Never mind that it's going to create an even bigger catastrophe down the road when the dollar loses reserve currency status and inflation spirals out of control and we end up in a hyperinflationary nightmare. That's future Fed chair's problem. That's somebody else's problem. Right now, they just need to keep the plates spinning. I've been warning about this for years. I warned about the housing bubble in 2006 and 2007 when everyone was saying housing prices never go down and subprime was contained and the Fed had everything under control. I was mocked. I was called Dr. Doom. And then 2008 happened. And suddenly I didn't look so crazy. I've been warning about the everything bubble that we're in now, the bubble in stocks and bonds and real estate, all simultaneously inflated by the most reckless monetary policy in American history. And I'm being mocked again. People are telling me I've been predicting a crash for years and it hasn't happened, so I must be wrong. But I'm not wrong about the diagnosis. I've just underestimated how far the Fed is willing to go in terms of money printing and market manipulation to delay the inevitable reckoning. The appointment of a new Fed chair in 2026 is being treated like it's some kind of fresh start. Like we're going to get somebody in there who's going to clean up the mess and restore sound monetary policy and get us back to normalcy. It's a complete delusion. There is no going back to normalcy. Normalcy would require allowing interest rates to reflect actual market forces, which would mean rates significantly higher than they are now. Normalcy would require allowing bad debts to be liquidated and zombie companies to go bankrupt and
misallocated capital to be redirected to productive uses. Normalcy would require a recession, probably a severe one, to clear out all the malinvestment and excess that's been built up over years of artificially low rates. And nobody in power wants that. Not the politicians, not Wall Street, not the Fed. So instead, we're going to get more of the same, more intervention, more manipulation, more money printing disguised with fancy terms like quantitative easing and yield curve control and whatever new acronym they come up with. And the consequences are going to be more inflation, more erosion of the dollar's purchasing power, more wealth inequality as the people closest to the money spigot get rich while working class and middle class Americans see their savings and wages destroyed by inflation. Here's what you need to understand about how this plays out for different asset classes. Stocks are going to be volatile. In the short term, if the new Fed chair signals dovish policy, you might get a rally. Wall Street will cheer. The media will celebrate. Everyone will pile in thinking it's a new bull market. But it's a bull market in nominal dollars that are being devalued. The real question is, what can you buy with your stock portfolio gains? If your stocks go up 20%, but the cost of healthcare and education and housing and food goes up 30%, you've lost ground. And at some point, probably when inflation gets so bad that even the manipulated CPI can't hide it anymore, the Fed is going to be forced to raise rates again, and that's going to crash the stock market just like it did in 2002. Bitcoin is going to continue being a speculative vehicle driven by momentum and narrative. When people are scared about the dollar, Bitcoin goes up. When people think the Fed is going to tighten and liquidity is going to dry up, Bitcoin crashes. It's going to be a wild ride, and some people are going to make a lot of money trading it, and a lot of people are going to lose their shirts. But Bitcoin is not going to become the sound money alternative that its proponents claim it is because it has fundamental flaws. It's too volatile to be a medium of exchange. It has no intrinsic value, so its worth is entirely based on collective belief. It requires complex technology infrastructure that could fail or be regulated out of existence. In a real crisis, it's not going to hold up. Gold, on the other hand, is going to shine. And I don't mean that metaphorically. I mean, gold is going to be the best performing major asset class over the next several years as the reality of monetary debasement becomes impossible to ignore. Central banks around the world are already buying gold at record rates. China is accumulating gold. Russia is accumulating gold. Countries that are trying to reduce their dependence on the dollar are buying gold because they understand that gold is the ultimate reserve asset, the ultimate form of money that can't be manipulated by any government. As the dollar weakens, as inflation continues, as geopolitical tensions rise and the U.S. loses its economic dominance, gold is going to go significantly higher, not because gold is changing, but because the dollar is being destroyed. The smart money isn't asking what the new Fed chair means for their portfolio. The smart money already knows that the Fed is trapped regardless of who's in charge. The smart money is asking, how do I protect my wealth from what's coming? How do I preserve my purchasing power when the dollar is being debased? How do I position myself to not just survive, but potentially profit from the greatest monetary crisis in modern history? And the answer to those questions is the same answer it's been for thousands of years. Own gold. Own physical gold that you control, not gold ETFs where you're trusting some financial institution to actually have the gold they claim to have. Not gold mining stocks, which are leveraged bets that come with company-specific risks. Physical gold coins and bars that you can hold in your hand or store in a secure facility that you trust. People ask me all the time, isn't it too late to buy gold? Hasn't gold already gone up too much? And my response is always the same. Gold hasn't gone up. The dollar has gone down. Gold is just maintaining its purchasing power the way it always has. In 1970, you could buy a decent suit for an ounce of gold. Today, you can still buy a decent suit for an ounce of gold. The purchasing power hasn't changed. What's changed is that it takes $2,000 or more to buy that ounce of gold instead of $35 like it did in 1970, because the dollar has been debased by 98%. And that debasement is going to continue. It's going to accelerate, and gold is going to continue to reflect that reality. The other thing you need to do is get your assets diversified internationally. Don't have everything denominated in dollars. Don't have everything in the US financial system. Look at foreign stocks, foreign bonds, foreign real estate in countries that have more responsible fiscal and monetary policy than the United States. Look at dividend-paying stocks in companies that produce real goods and services and have pricing power to pass inflation on to consumers. Look at commodities and natural resources that benefit from inflation and monetary debasement. Don't just sit there in a conventional portfolio of US stocks and bonds thinking that's safe because that's what your financial advisor told you. Your financial advisor is working off a playbook that was written in a different era when the US had a real economy and sound money and fiscal responsibility. We're living in a different world now. We're living in a world where the government debt is unpayable, where the Fed has destroyed the price discovery mechanism in financial markets, where asset bubbles are the norm rather than the exception, where crisis and intervention and money printing are the regular operating procedure rather than emergency measures. In this world, conventional wisdom is going to get you killed financially. You need to think like an Austrian economist. You need to understand that money printing creates inflation, that artificially low interest rates create malinvestment, that government intervention makes problems worse, not better. That debt has to be repaid or defaulted on, and inflation is just default by another name. The new Fed chair for 2026 is going to walk into a situation where there are no good options, only bad options and worse options. They can raise rates to fight inflation and crash the economy and the markets. They can keep rates low and let inflation run hot and destroy the currency. They can try to thread the needle and do a little of both and probably end up with stagflation, where we get slow growth or recession, combined with high inflation. But what they can't do is wave a magic wand and make the structural problems go away. They can't make the debt disappear. They can't make the trade deficit disappear. They can't make the unfunded liabilities disappear. They can't restore America's manufacturing base and productive capacity with monetary policy. This is basic economics. This is Austrian economics. You can't print your way to prosperity. You can't borrow your way out of debt. You can't consume more than you produce indefinitely. These are fundamental truths. And the fact that the Keynesians at the Fed and in academia and in government refuse to acknowledge them doesn't make them any less true. The bill is coming due. The consequences of decades of monetary and fiscal irresponsibility are going to hit, and it's going to be painful. The standard of living for the average American is going to fall because it has to fall to reflect the economic reality that we don't produce enough to maintain the lifestyle we've been living on borrowed money. So when you're watching the financial media breathlessly cover the new Fed chair appointment and analyze their every word and try to figure out what it means for your 401k, step back and see the bigger picture. See that this is a scripted show, that the outcome is predetermined, that the new Fed chair is going to do exactly what they need to do to keep the system from collapsing immediately, even if it means making the eventual collapse much worse. And position yourself accordingly. Get out of long-term bonds, which are just certificates of guaranteed confiscation through inflation. Reduce your exposure to overvalued stocks trading at insane multiples. Get into gold and silver and real assets that can't be printed. Get some diversification outside the dollar and outside US markets. And most importantly, don't believe the hype. Don't believe the Fed when they tell you inflation is under control. Don't believe the government when they tell you the economy is strong based on fake GDP numbers. and manipulated employment statistics. Don't believe Wall Street when they tell you stocks only go up and you should buy the dip. All of these institutions have incentives to lie to you, to keep you complacent, to keep you invested in a system that's rigged against you. The Fed needs you to believe so confidence doesn't collapse. The government needs you to believe so they can keep spending and borrowing. Wall Street needs you to believe so you keep putting money into their funds and paying their fees. I'm telling you the truth, even though it's unpopular, even though it's scary, even though people don't want to hear it. The new Fed chair changes nothing fundamental about the trajectory we're on. We're headed for a monetary crisis, a debt crisis, a currency crisis. It's not a question of if, it's a question of when. And when it happens, the people who prepared, the people who own gold and real assets and position themselves outside the dollar-dominated system, they're going to be okay. They're going to preserve their wealth and potentially increase it. The people who believed the lies and stayed conventional and trusted that the government and the Fed would protect them, those people are going to be devastated. This is your warning. This is your wake-up call. The appointment of a new Fed chair in 2026 isn't a solution. It's just another chapter in the slow-motion train wreck that is U.S. monetary and fiscal policy. Protect yourself while you still can, because once this thing really gets rolling, once confidence in the dollar starts to crack, once foreign creditors start dumping treasuries, once inflation really takes off, it's going to be too late to react. Get your gold now, get your assets diversified now, get prepared for a very different economic reality now. Because I guarantee you 5 years from now, we're going to be looking back at 2026 and the new Fed chair's appointment, and people are going to be asking, how did we not see this coming? Why didn't anybody warn us? And I'll be sitting here saying, I told you so, just like I did after 2008, because I'm telling you so right now,